And now for something completely different.
It's a Rick Bass world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome back to the show this morning at 6:06 on this second best day of the week, right? It's Thursday. Friday's right around the corner. Kind of a bit of a wintry weather still, so it's been a little bit cold and chilly here in Houston, but colder elsewhere in the country. So, I'm not complaining. My wife and I went out to dinner last night, and she's been working really hard, so I took her out to dinner. And
al fresco?
Just not al fresco, just just a quickie. And so we went out for dinner just to spend a little time together. I haven't seen her much lately because she's been working a lot, and so went out to dinner, and so have a great meal, and we're getting ready to pay the bill, and the check comes, and I pull out my wallet. My wallet's like falling apart, right? I mean, I've had this wallet for like 15 years, and it's my favorite wallet.
Yeah.
I mean, it's just really gotten to where it's really broken in. It fits in my pocket, exactly right. And my wife is appalled at my wallet. And she's like, you have got to get it. What is it with women and things that are now broken in? I mean, your underwear have a couple of holes in it, but those are just getting broken in. And she's like, we got to get you a new wallet. I'm like, no, it's taken me 15 years to break in this wallet.
I'm with you. So, I'm with you.
I don't understand it. But just because a few things get little holes in it, worn out, doesn't mean you got to throw them out.
So she's going to bring one home now that if you put it in your pocket, it'll throw your back out of alignment.
Exactly. This is exactly the point, So I'm just worried she's going to, worry about the same thing as I get a little old and worn out. She's like, let's get rid of it.
Well, that happens.
Anyway, don't get rid of old stuff. Old stuff is good stuff. And besides that, about every 20 years, everything is back in style anyway.
Oh,
so, yeah.
I've got a whole stock of new ties.
Exactly. Hey, 8 tracks, they're coming back.
I'm telling you.
So...
And cassettes.
It was funny. So I told you yesterday that my daughter's car has been having a lot of trouble with it. And so we've been figuring out whether to buy an extended warranty for her so that she can, just deal with it, or just trade it in on a new car. And right now, car values are so high.
Right.
Right. Now, this is crazy. She just bought this car a little less than a year ago. And the car is worth more now than it was a year ago.
Wow.
So... the trade-in was obvious, right? So she traded it in on a new car, had a $2,500 in equity in a car that she's owned for 1 year.
Hey, she did good.
She did very good. And what's so funny is, though, this new she traded it on a little Mazda M3 that she wanted.
Yeah.
And it comes with a CD player.
Oh, what?
A CD player, right? And she goes, well, it has a CD player in it. And I'm like, well, yeah, but it does all your Bluetooth and stuff, right? She's like, yeah, absolutely. But she's like, does anybody have CDs anymore? I was like, look, cassettes are, and I actually said this. I said, don't worry, cassettes are coming back. Hey, people are buying albums again, LPs, right?
LPs, vinyl is king.
Vinyl is coming back. Got to have the scratch. Music is not music without a few scratches and little pops along the way. That's real music. Anyway, I digress. Let's get to work this morning. A few things to talk about as we kind of get the world going this morning. Michael Lebowitz will be joining me to talk a little bit about Joe Biden's new package. Today, Joe Biden is going to talk about his new stimulus package, $2 trillion. And what we'll talk about this morning is why that won't create long-term economic growth. This is really kind of not surprising. Stimulus that does not create productivity in the economy does not create economic growth. So again, this is kind of the new norm that we've been in, increased debts and deficits and slower economic growth overall. Yes, you're going to have a short-term pickup in economic growth, but we'll explain to you why this actually won't lead to the inflationary pressures that a lot of people are concerned about right now. And it's just a function of math and how money works in the economy. But we'll go through that in more detail this morning. But in the short term, more stimulus, of course, another $2 trillion, $2,000 checks to household, extended unemployment benefits. Of course, the key driver here in this package is going to be federal aid to states. Now, we've talked about before about why this is a bad idea because basically giving money to municipalities. They have access to capital markets already. They can issue municipal bonds, they can raise debt, they can do these things. So using federal debt, which is now puts the burden on taxpayers to give money to these cities, they misappropriate this money anyway. And I don't mean that in a criminal term of misappropriation, but they misuse the money, right? A lot of this money will go into just fund pension plans that have been vastly drawn down on. They'll use it for kind of wish list projects for the city. A lot of it will be wasted through normal operations of municipalities. And again, this is why a lot of these cities run deep deficits, AKA Houston, Texas. We have a very poor track record of fiscal responsibility in Houston, same in basically every major city around the country. So, this is going to be one of those issues that continues to really be a problem, is that yes, we'll give them money and yes, it'll shore up a real short-term problem. But again, this is kind of like giving money to a drunk, right? I give money to him and because he's down and out on his luck, I give money to him, he spends it on more alcohol. He doesn't solve his problem, which is get himself back up into the world and becoming a productive citizen. It's the same problem here, is that basically we're propping up drunks all around the city, in these major cities. We're not helping them solve their problems. We're just buying them some time to continue to do what they're doing and to get further and further into debt as they do it. So again, this is why this stuff doesn't work out. But we're going to talk more about that in detail today. But in the short term, obviously, it's going to provide a pop to the economy. You'll get a short-term lift in economic activity. Why? Because somebody $2,000, they're going to go out and buy stuff with it, right? So automobile prices will go up, home prices will go up, food prices will go up. Prices will lift to accommodate for that $2,000 check. So yes, in the short term, you're going to see some economic activity. You're going to see a pickup in inflationary pressures. But again, it'll be transient because you're not creating long-term productive activity within the economy. But like I said, in the short term, it's all positive. It's going to lead to a lift potentially in markets as well. Lots of speculation in the markets yesterday. The top 5 performing stocks were all under $1. So that just goes to show you where we are in the markets currently. But really, the market hasn't done a lot here over the course of the last few days. It's been really kind of chopping around a good bit, really all week around the same level, really not making a lot of advance here, really one direction or the other, not going down, not really going up. That's good news, right? So we're holding up around all-time highs. The not so good news in terms of, to call it that, is that the more time we spend kind of chopping around at high levels, the more of our money flow indicator that we're just eating up. So it's kind of like sitting in a car and idle with your foot on the gas. You're just burning a lot of gas, but you're not going anywhere. And that's kind of really what's happening in the markets. Markets aren't going anywhere, but we're using a lot of the previous kind of oversold money flow conditions, using that kind of fuel just to sit there and hold the markets where they are. So again, pay attention here. We've got another week or so before this money flow indicator tops out and rolls over. So again, there is some short-term lift to markets. Moving averages are trending higher. That does help push prices higher in the short term. But again, we're starting to get potentially to the end of this kind of run here. So I suspect that within the next 2 weeks to 3 weeks, we'll probably get a short-term correction. That'll probably put markets back down here, basically to where we were back in December. Wouldn't be surprising. 5 to 7% correction, well within context of norms, and more importantly, what we see typically in the month of February and March. Just keep watching that. Also watch yields on bonds. That's also starting to creep up here very slightly. Yields had a big day yesterday as money was flowing into treasuries. So watch these things in particular. We're going to talk more about that with Michael Lebowitz here. Get by the website, realinvestmentadvice.com, realinvestmentadvice.com. Send your questions, comments, emails. We'll be right back with Michael Lebowitz, CFA. Don't go away.
She brings home her pain for love. For love.
You're listening to The Real Investment Show.
Get 2020 off on the right foot with our next Candid Coffee Financial Bootcamp. Get Fiscal with Richard Rosso and Danny Ratliff and learn the landmines to avoid, tax advantages we see, and money tips you need to know. Our next Candid Coffee can better prepare you for the changes we'll see in the new year with a new administration. Get Fiscal with Ratliff and Rosso. Register for the 2021 Financial Bootcamp edition of Candid Coffee Saturday, January 16th at RIAadvisors.com. RIAadvisors.com.
The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. It is, of course, Thursday. We have Michael Lebowitz joining us this morning. And to talk a little bit about monetary policy, I guess, in a sense, Joe Biden today will be his official announcement. But, rumors kind of leaking over the last couple of days about the size of the stimulus package that he wants to announce, right? So it's been running somewhere between $1.5 trillion and $2 trillion. And that is certainly, kind of the expectation here. It's as of early this morning, it's been kind of creeping up over the last 24 hours. And as of this morning, we're now at $2 trillion. That's the expectation now. Now, where's a lot of that money going to go? As I was talking about just a second ago and kind of in the monologue, this is stimulus for a pandemic economy, right? So it's going to be $2,000 checks to households because the $600 we just sent out, apparently not enough. So we need to add another $2,000. Also extended unemployment benefits. Those will probably creep up from $300 back to $600. Wouldn't surprise me at all to see that in the announcement. But of course, kind of the big thing here is going to be money for both increasing and supporting the vaccination rollout, but also giving money to states and municipalities. And as I noted a second ago, municipalities have a horrible track record of management of being physically responsible, right? They a lot of these big cities run massive deficits. Detroit's been virtually bankrupt now for years. So we give them money, that doesn't help solve their problem of fiscal irresponsibility. That's just going to basically fill in some holes that they've created temporarily. But again, you don't solve the problem of creating more employment or creating better economic situations so that their tax revenue goes up so they can support their spending because they continue to outspend what they can generate in revenue. So while you create a short-term Band-Aid, it doesn't solve your long-term problem. So in other words, we wind up right back where we are again now in a year, right? So either you've got to keep doing this or you wind up back here. So we're having some technical difficulties this morning. So Michael Lebowitz is going to join us by phone this morning. And so Mike, this is going to be a couple of the big issues here. One of the concerns, of course, is that more stimulus is ultimately going to lead to massive runs of inflation. And, we've had a big spike in monetary supply over the course of the last year, and big concerns that that's all going to lead into massive inflationary pressures in the economy. And if we take a look at the velocity of money, it's not really showing that that's the case at this moment. We're printing a lot of money, but it's not really flowing through the economy in terms of monetary velocity.
So here's the way I would kind of say that this fiscal stimulus, along with the last one and other fiscal stimulus, will give us a very short-term boost of inflation. Mm-hmm. It's going to put money in, we're all going to get another check for whatever, and we're going to spend it, and it's going to flow through the economy, and that's going to last for 2, 3, 4, 5 months, whatever it lasts, right? Then it goes away. And then we're dealt with the long-term effect that we just blew all this money. We bought a bunch of stuff, and then it dwindles. So I would say, yes, we'll get a slight boost to inflation followed by even further pressure, further deflationary pressure. So all we're doing is piling deflation onto the future.
Right.
And the problem is, I'm actually writing an article on this. Every day on social media, I see a graph of M1, which is the money supply, how much money is out there.
Right.
And it's the so-called hockey stick. It's been going up in a straight line. And that's because the Fed's basically putting $120 billion into the money supply via QE every month, which is an enormous amount of money, right? So everyone looks at money supply. It's going through the roof. They think of, Germany, the Weimar Republic in Germany, where all they do is print money. And there's great pictures of people walking around with wheelbarrows of money to buy a loaf of bread and all that kind of stuff.
True story, by the way.
All true.
Yeah.
All true. And the money supply is rocketing up. But what they don't realize is that monetary velocity, which is how much we spend, how often we spend it, is dropping like a rock. Mm-hmm. So let's just do a little thought experiment, right? The Fed comes out today and says, we're going to print $50 trillion. They can do two things with the money. First of all, 50 trillion is 10 times approximately the money supply right now, right?
Right.
They can do two things with the money. We're going to dig a hole and we're going to drop the 50 trillion in there and we're going to seal it and we're going to have security guards and no one can get at it, right? Okay. Or they can write us each checks for $50,000 and those checks, expire in a week, right? Okay. And if you receive one of those checks, you have another week to spend it again and so on, right?
Okay.
Monetary velocity in that case will go through the roof. The inflation will be hyperinflation like we saw in Germany 100 years ago. Right? So those are the extremes of money supply and velocity. Right? And, we're not getting either one right now. We're getting a little bit of the latter where we're giving checks. Some people will spend it. A lot of people will save it. A lot of people will pay down debt. And some of it will get spent, and it'll get spent once. It's not going to keep circulating through the economy.
Right.
Some of it will sit in a hole, right? The Fed's sitting right now on the Treasury is sitting on $1.6 trillion from the last stimulus.
Right.
That money, and the Fed has done QE to match that amount of money. So literally the Fed did 1.6 of QE that's sitting in a hole right now. It'll come out. It'll leak out. But that's, so that explains money supply and velocity.
Well, and here's I think the when we talk about this and we say, look, we need to do this stimulus to help support the economy. Look, we talked about this early on right after the pandemic, and there was a couple of good charts out of the last couple of days. Of course, we've been talking about employment. December was a lot weaker than expected. And what we notice is right after the pandemic first came out, we were talking about all these temporary layoffs. Everybody that got laid off thought it was a temporary layoff. Oh, my boss laid me off, but it's just temporary. As soon as the virus passes, I'll get hired back. Well, the reality is that's not the case. A lot of the many of those temporary job losses have now become permanent losses as the economy is not recovering. We're not getting past the virus, and even with the vaccine and wearing masks and social distancing, the virus is still spreading and actually getting worse now. So we're not getting back to that growth rate, and businesses have now adopted, or I shouldn't say adopted, but have adapted really to this new environment, right? I don't need to have a lot of office space because people can work remotely. Oh, I'm finding out that really I didn't need Jim and Bob and Mary and Sue. They were great employees, but I'm really doing just fine now with my business because we're doing more online and more virtual, things that I don't really need those extra bodies. So what's happening now is this adaptation to the new environment is also restricting job recovery in a lot of degrees, and those jobs may never come back to a large degree. And this is part of the problem is that, there's definitely a need for people that need financial help. I get that. I'm not saying we shouldn't do stimulus, but the problem is that stimulus does not create productive activity. And in order to have sustainable economic growth that's going to lead to inflationary pressures and these type of issues, you've got to have increases in productivity that is sustainable. In other words, just giving you money today to go spend tomorrow is fine, but that doesn't create a long-term recurring productivity that increases consumption pressures within the economy, rising levels of demand, rising prices, rising wages, most importantly, over the long term. These are one-off impacts that when they go away, you're right back in the hole you started with.
Right, and here's what no one's questioning. Mm-hmm. Right, I agree with you. We need to help people out. Let's do stimulus, right?
Right.
Why are we just writing blank checks to a whole bunch of people that have the same jobs they had before COVID started, or have new jobs that are paying them well enough, right? Why isn't it just unemployment benefits? Why is anyone getting a check that was making the same amount of money they were making before? It makes no sense. And part of it is because jobless benefits pay more than having a job. Right. So it's this whole trap they catch themselves in.
And now they're paying. Right, which is also anti-productive, by the way. If I pay people more than they were making working, there's no incentive to work, right, to be productive.
Exactly.
Right, so that's the other problem.
Well, and that's what we find with just about everything that we've seen over the last year and a half with government spending. Mm-hmm. There's zero productivity value to it, right? It's not going to pay any dividends in the future. It'll help people out, and that's fine. But it's also going to allow a lot of people to buy something extra that they didn't need that extra money. Right. They could have worked on their own.
Yeah,
they could have
Yeah, and to your point, though, I mean, Mike, you make a good point here. It's like we're just kind of, shooting out $2,000 checks to everybody. My son will get a $2,000 check. He lives in Germany. But he'll get a check because he files U.S. taxes, and, he makes way less than the amount. So he's going to get a check. He doesn't need a check, right? He's just fine. But to your point,
and he's not going to spend it in America.
This is true. But, we send out these checks to everybody, and it's fine. But to your point, we talk about, we have 10 million people that are unemployed. Great. Let's send those 10 million people $2,000 checks. They need it. They're unemployed. But if you're working, maybe we need to rethink about how we're sending out money, because again, we do these blanket things. And look, there's article after article after article right now. Billions of dollars of these stimulus packages are lost. They're checks sent to dead people. We've got tons of taxes, checks that were sent to the wrong people because of TurboTax filings and all kinds of stuff. I mean, it just goes on and on and on. It's just we try to do these shotgun approaches without really any type of methodology behind it. We wind up wasting billions of dollars in fraud and all kinds of other issues. We saw the rapper, of course, got $1.5 million in basically fraudulent unemployment claim checks, and makes a video about it, gets arrested. But hey, but that's what goes on, right? That's what goes on. We need to think, again, if we want to help people, that's great, but we need to think through how we do this and make it a better process so we get the money to the right people at the right time. Be right back after the break. More with Michael Lebowitz. Don't go away.
Me?
People say, hey, yeah.
Listen anyplace, anytime at realinvestmentadvice.com.
Get 2020 off on the right foot with our next Candid Coffee Financial Bootcamp. Get Fiscal with Richard Rosso and Danny Ratliff and learn the landmines to avoid, tax advantages we see, and money tips you need to know. Our next Candid Coffee can better prepare you for the changes we'll see in the new year with a new administration. Get Fiscal with Ratliff and Rosso. Register for the 2021 Financial Bootcamp edition of Candid Coffee Saturday, January 16th at RIAadvisors.com. RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning at 6:33. Michael Lebowitz joining me, and we actually have live video now. We actually got our gremlin out of the system this morning. This has been going on the last couple of days. We've had a lot of gremlins in the system. I'm not sure exactly what's been happening, but ever since the whole big Twitter purge.
Should it be censorship?
I don't know. Anyway, welcome back, Mike. Got you now. Got video.
Great.
So just for the break, we're talking, and I want to take a step back here for just a second, and talk about this idea of more stimulus, because this is modern monetary theory in action, right? And we've talked about this on the show before. Modern monetary theory is neither modern or monetary or a theory, but this is the new kind of idea that we can just, as long as we can just print money and issue debts, debts and deficits don't matter, because if a debt comes due, right, if China says, hey, we want you to, redeem all the bonds that we own of yours, we just print the money to give the money back to China. So it's no problem, right? We can just print currency. And this is the part that everybody falls into the trap of, right? They say, this is great. Modern monetary theory is the answer to everything. We can just print debts and deficits and just give everybody money, and the economy is going to do awesome, right? We're going to create massive economic prosperity by doing this. The thing that everybody forgets is there's constraints to modern monetary theory. And even Stephanie Kelton, who is the biggest promoter of modern monetary theory, she even admits this in her book. She says the only constraints of modern monetary theory is inflation, right? Now, if you get inflation, which also leads to a sharp rise in interest rates because interest rates and inflation track each other. Then all of a sudden you got problems and you can't do this anymore because all of a sudden your cost of your debt burden starts to rise dramatically, and inflationary, as you get more inflation in the economy, that's causing other problems with expanding your debts and deficits, right? So,
can I stop you right there for 1 second?
Yeah, you can. But I just want to say those are the constraints. But this is kind of the nirvana that people have fallen into with this trap of modern monetary theory, is that debts and deficits don't matter.
Right. So here's the other, I think even it's a bigger problem than the hocus pocus you've been talking about.
Yep. And by the way, that's what it is. It's hocus pocus
theory. HPT. According to MMT, when you get inflation, the way to counter inflation is your gauge on how much money you can print.
Right. So
when you get inflation, you tax people, you tax corporations, whoever you tax, and in theory that lowers inflation. Right. So right now, the way that it's supposedly done is with interest rates. The Fed governs interest rates, they govern money supply, and that's what in theory helps keep inflation in check.
Right.
We would both argue that helps keep deflation in check.
Right.
But regardless, so what they would do is tax more. So let's think about this. We get inflation. Well, we can't have inflation, so we tax more. So who makes these decisions? It's not the Fed anymore. It's politicians.
Right.
Which politician is going to, first of all, tell you there is inflation because they don't want to tax you more?
Right.
Right. So they're going to say, they're going to get the report on their desk, whoever it is, the president, the Speaker of the House, Speaker of the Senate, Senate Majority Leader, whoever it is, and it's going to say inflation's running 7%. They're going to say, go back to the BLS and fix that number. Make it 2%. Because I'm up for re-election in a year,
right,
and I can't raise taxes. Who can raise taxes? Look what's going on in the economy.
And by the way, if we have 7% inflation, that means all your Social Security payments are adjusting by 7% a year, which you've already got a massively underfunded Social Security system. So a sharp rise in inflationary pressures increases the burden upon Social Security and Medicaid, Medicare programs to a great degree, especially when you're talking about a $70 trillion unfunded liability between those three programs.
Right. So even if you believe in MMT, right, even if you think it works, and there are some merits to it, but there's also a lot of big problems with it, you also have to believe that politicians are going to do what's best in our interests,
right?
Not what's going to do them best to gain power, money, and get them reelected.
Right.
So if you can buy into that, you should be sold.
Yeah.
It's a great system.
Well, let's just go back in history real quick. Ronald Reagan, 1980, gets elected, 1982, right? Comes into office. Inflation's running, 14, 15%. Interest rates are running 14, 15%. He teams up with Paul Volcker. Now, at this time in the economy, we are running a very small deficit in the economy. I mean, you can barely see the deficit that we're running in the economy at this point. Probably total debt, and I don't have it right in front of me, is probably $1 trillion, maybe at that point back then. So, we don't have a lot of debts or deficits in the economy. Now, Keynesian economic theory says that in a recession, the government should spend money, use debts and deficits in a recession to help get the economy out of recession. And then once the economy's out of recession, then go back to running a surplus. Okay, that's the theory. Ronald Reagan says this is a good idea. Look, we had just double back-to-back recessions, the 1974 crash, 2 recessions, literally back-to-back, spiking, surging inflation and interest rates. Got to fix this problem. He teams up with Paul Volcker, and they go into a deficit spending program per Keynesian economic theory to get the economy righted and get things going. And he does. He creates 9 million jobs. The economy starts to recover. And then that's where the theory all goes haywire, because George Bush comes into office and says, hey, if a little deficit spending did that, let's do some more. And then Clinton says, hey, if that deficit spending worked, let's do some more. And by the way, let's also rejigger the way we count for inflation, and let's move a couple of $1 trillion over from Social Security into the government general coffers to help, get a surplus here for about 2 minutes. George Bush II comes in. Hey, little more deficit spending's great. Let's keep doing it more. Obama, let's double it. Trump, let's double it again. Here we are. The point is that once they get into, and then we see this now with even Biden, once they're in this trap of deficit spending, there is no look back at fiscal responsibility. It's easier to spend money. It's easier to give people money to get votes, even though it doesn't. And then everybody stands around and goes, I can't figure out when we can't get economic growth. Let's do more stimulus, right? So,
right. And as you went through that timeline, notice it was Democrats and Republicans.
They're all
it didn't matter.
It doesn't matter.
It really didn't matter. No matter what they sell you, what they want to do is spend money because that's what gets them elected.
Right. Well, look, I mean, when Republicans have been pounding on the table for years, and look, and just for clarity, I'm a fiscal conservative, right? I believe in fiscal responsibility in government. That's crazy me, and I think this is why a lot more people are starting to lean more towards independence. Rather than calling themselves a Republican or a Democrat, a lot more people are starting to call themselves independent because the parties no longer really represent what people think within the economy. And even though we see a lot of this division in the world between right and left, that's actually becoming a smaller and smaller fraction of the total population. But this is the problem, right? We continue to do these policies to get reelected, rather than somebody coming in and taking the reins and saying, look, let's do the right thing. Republicans for decades have been talking about being fiscally responsible. Everybody wants to go back to being Reagan, right? Let's go back to be Reagan and let's be fiscally responsible. He wasn't fiscally responsible. He was doing debts and deficits to create economic activity, to repair and to get the economy going again after the 60s and the 70s. It's a 20-year period where markets went nowhere, right? But we forgot the other part of Keynesian economic theory is that you've got to get back to a surplus when times are good, and we just don't do that anymore. The Federal Reserve for a decade kept rates at zero, even though the economy was growing, right? Should have been raising rates in 2010, 2011, trailing off QE. Would the markets be where they are today? Absolutely not. We'd probably be about half of where we were back then, but the economy would be stronger. We would have natural organic economic growth, and we would have a surplus that we can now be talking about using to fight the pandemic. But we just don't do those fiscally responsible things.
No, and what's funny is what Keynes's theory really says, as you said, is deficit spend when times are bad and run a surplus when times are good.
Right.
We all do that in some way or another, right? Right. We personally, when times are bad, we tend to borrow more because we need the money. And when times are good, we put it away, we save it, we invest it. And as citizens of the country, most of us seem to understand the game, although the number of people that understand it now has been slipping rapidly, I fear, because of what the government's doing, in part, and social attitudes. But we get it, but we don't vote for it, right? We understand that, there's a season for every purpose,
sure.
Right? There's a time to save and a time to spend. And if you go out and make a big purchase, I remember we bought our house, and at the time it was $300-something thousand. I was like, oh, we're not going to be able to go out to dinner. We're not going to be able to do this. And for 6 months, we did nothing, right? We were like, oh my God, there's another mortgage coming. But now,
honey, we bought a prison.
Now keep in mind, mortgage rates were 8%, so the mortgage check was nothing to joke about.
Right.
But we thought about it, and we were conscious about it, and still to this day, there are times, like usually after the holidays, where I'm looking at those Visa bills. I'm like, we just got to cut back for a little bit. We just spent way too much money.
Yeah.
And I think most of us do that.
Yeah.
But the government doesn't do that.
Well, and if you were listening to the first of the show, I was talking about my wallet. My wife wants to buy me a new wallet because I've had this wallet for like 15 years and it's falling apart, and she's embarrassed that I have this wallet. She's like, I'm buying you a new wallet, which is like $15. I'm like, no, we can't afford it. So, yeah, but you're right. I mean, we have to save money in order to be prudent and fiscally responsible. And look, I know the government's not a household, but the fiscal monetary policy is much like a household. You've got to save money and be responsible to have a healthy economy long term. Be right back after the break.
Love isn't always on time. Whoa, whoa, whoa. It's not in the words that you told me.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get 2020 off on the right foot with our next Candid Coffee Financial Bootcamp. Get Fiscal with Richard Rosso and Danny Ratliff and learn the landmines to avoid, tax advantages we see, and money tips you need to know. Our next Candid Coffee can better prepare you for the changes we'll see in the new year with a new administration. Get Fiscal with Ratliff and Rosso. Register for the 2021 Financial Bootcamp edition of Candid Coffee Saturday, January 16th at RIAadvisors.com. RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. Mike Lebowitz joining me. Look, and we're talking about Joe Biden's upcoming announcement today. He's going to talk about a $2 trillion stimulus package for the economy, right? The pandemic economy. Direct checks to households for $2,000, increased unemployment bits, extended unemployment benefits. One of the interesting questions is whether or not they're going to extend the moratorium for mortgage payments and for rent, because there's a problem there that exists. There's a lot of people that invest in these properties, right? I mean, you've heard commercials on radio for years, TV, et cetera, about how to buy rental properties, how to buy apartment buildings, how to buy commercial real estate and then collect this passive income. Well, all of a sudden, that whole passive income stream is now zero because of the moratorium, right? And you can't evict them because of the moratorium to get renters in that'll actually pay. So there's a economic damage that's created under these moratoriums. Sound great, but there's always, nothing's a free lunch, right? Somebody picks up the tab on everything that we do. You want to do more stimulus? That's fine. Somebody picks up the tab. There is no free lunch. So there is a payback for all of this that we do. While seemingly that we do it for the best of reasons, we don't think through what the long-term consequences of these things are, because again, there's no free lunch. And there's a payback. So, and this is kind of what we've been talking about this morning. Sure, another $2 trillion. Who cares, right? I mean, we did $7 trillion worth of spending last year, right? So what's another couple of trillion this year? Well, it's $2 trillion on top of the $4 trillion that we're already doing on an annual basis. So now you're talking about another 6 to 7 trillion. Add that to the debt. Now we're going to be pushing about $30 trillion of debt in a $19 trillion economy. Yeah, so that's the problem. But Mike, there's a payback, and and we're going to see this payback in some other forms, right?
Right, and we have been and we will be, right? Just look at a 30-year graph of GDP growth. Mm-hmm. That's your payback, right? Right. You started with Reagan 40 years ago, and that's when our debt started really increasing in earnest, and that's when growth started really declining in earnest, year after year. It trended, right?
Right.
So all this debt that we're doing now, that we're doing we've done in the past, will get paid back. The question is, how does it get paid back? It'll get paid back maybe in taxes. Maybe we really increase taxes and we decide that we're going to be a little more fiscally conservative and we're going to pay it back that way, right? It can be paid back in inflation. You run a couple 100% inflation for for a few years, and there is not much debt left, right? It doesn't mean the debt's not there, but just GDP will double, right? Because the price of everything is going up 2-3 times, right? And we're certainly going to pay it back in slower economic growth. We're just harming productivity, as we've talked about over and over again. And we're going to pay it back in lower wages. We're going to pay it back in very weak economic growth. We're going to pay it back with zero interest rates that only spur speculative growth and not investment growth. So it's going to be paid back. Just because it's not paid back the way me and you pay our debt back in dollars, right? It's going to be paid back, and it's going to be harmful, and it's going to be a tax of some sort, whether it's an actual tax that we pay or a tax that we feel.
Right. Now, here's an interesting conundrum, though, right? So you just made a point that, yes, it may go up. This will probably lead to zero interest rates, more speculative investment in the economy, et cetera. And that's fine. That's the top 10% of income earners own about 90% of the stock market. That'll probably be about 95% by the end of this year. So we're concentrating wealth, at the upper levels of the economy anyway. But this potentially really puts the Federal Reserve in an interesting predicament because already we're hearing some trial balloons. And again, whenever the Fed speaks, you have to listen to the Fed because they've been dropping some trial balloons here lately, very subtle comments coming out. And then they don't do it from the main speakers. You won't hear Jerome Powell say this. They get their kind of one-off minions to come out to the public and make a speech that says, yeah, we're thinking about maybe tapering QE over the course of, maybe starting as early as June or July. They drop that little bomb and they see how it goes in the markets. If markets don't really react too much, they drop it again. And this has been dropping now for a couple of weeks now. We've heard several speakers come out talking about potentially tapering quantitative easing sooner rather than later. And of course, to make sure nobody kind of panics, they'll have somebody come out and contradict them. No, we're not actually going to do it. And then they'll drop the hint 2 more times. But that's how they test the markets, right? Will markets be okay if we start to taper? The problem with this is that, great, more stimulus is fine. You start creeping up. And again, if you take a look at a lot of measures of inflation, even in core, we're starting to see those core inflationary pressures pick up short term because of the way stimulus works and the economy creating short term economic pressures. If that occurs, that's going to potentially put the Fed in the box of having to start talking about hiking rates and starting to taper QE, which is going to pull the liquidity flow potentially out of the markets. So even though you don't get increased economic recovery, the Fed could get trapped in a box of having a falling stock market, but stagflationary pressures in the economy that keep them from doing more QE to help bail out the stock market. So they could very well be putting themselves in a box here very shortly that leads to worse than anticipated, financial outcomes.
Yeah. Oh, they're in the box already, right?
Yeah.
I mean, they keep putting themselves further and further into this hole. That's their own making, right? And they're doing it to support the Treasury so the Treasury can do whatever they want, so the politicians can get whatever legislation they want. But this has a very limited life, and we are seeing some signs of some very short-term inflation. And it also doesn't help that some of the supply lines are still messed up from COVID.
Right.
So that's not. It is inflation, and it's higher prices we pay, but it's transitory. When the vaccines come and the COVID goes away, those supply line problems go away. But there are some real inflationary, like food prices are going through the roof. We're seeing crude oil now is back in the mid 50s. Right.
Now that has a lot to do with the falling value of the dollar, though, correct?
Some of it,
yeah.
Absolutely. But demand is picking back up again, right? I mean, there is some economical aspect to it too. People are starting to fly again. There are things going on. But this is all a tax on us. Inflation is a tax. And what I love is that when the Fed looks at these numbers, CPI, for instance, that's put out by the BLS Bureau of Labor Statistics. And they put out 2 numbers, CPI and CPI excluding food and energy. And the Fed likes excluding food and energy. Ask yourself, where do you spend your money besides food and energy? I mean, that's a huge portion of where I spend my money, right? Every breakfast, lunch, and dinner,
my
I'm
wife.
eating.
She spends it all on Amazon.
Right. But it's just so much of what we spend is food and energy. And yet the Fed says those prices don't count. They're transitory. They're just, they go up and down, and we have no way. That doesn't count.
Right.
Let's just focus on other things that are not as volatile.
Well, okay, that's fine. Let's do that, right? Automobile prices have been surging through the roof. I told a story at the beginning of the show. My daughter just traded in her car that she bought a year ago because it's just had she bought this used Jeep. It's been having a tremendous number of problems. She went to trade it in, and because prices have spiked so much in auto prices since she bought the Jeep, she actually had $2,500 of equity built into this Jeep already that she traded it in and got a better car, right? That should never happen in a 1-year-old used car. But that's exactly what's happening in the economy, and we're creating these abnormal structures because, great, I give people $2,000 or $600 extra in unemployment benefits. They go out and they buy a new car. Again, not pulling forward. We talked about this before. We're pulling forward consumptive activity, and if we give people another $2,000, they're not going to go out and buy another car.
No, and we're encouraging people to just consume crap.
Right.
We're not saying take this $2,000 and do something productive with it.
Right.
Use it for education. Use it to join a gym and make yourself healthier. Use it for something that will pay you benefits in the future. That's not what we're saying.
Or, look,
That's what we're saying.
Right. I have no problem sending everybody in the country $2,000. I mean, send everybody, right? Or I tell you what, let's do this. Let's send to everybody in the country $50,000, right? 300 million people, everybody gets 50 grand. Doesn't matter what your income is. You get 50 grand. You can only use it for one thing, though, paying off debt. And you have to either pay off credit card debt, mortgage debt, whatever it is, because if you lower the debt burden on average households across the country, now they have more consumptive capability, right? And now they've used that for a structure that helps them out longer term by reducing their interest service, et cetera. That would be a better long-term use of stimulus than just saying, hey, go buy stuff with it.
I guess. I have problems with that too.
I know. Look, it's not a perfect solution, but it's better. I mean, there's
things
no
they're doing
good
now are awful.
Yeah.
Right? They encourage zero for the future.
Exactly.
It's all about let's just boost the economy today. We can't have negative economic growth.
Yeah.
Right? That's what this is all about. And we're just going to put money in your pocket. You got to go spend it. You got to spend it. You can't pay down debt. Right? That's what they're telling us.
Right.
That's what they're encouraging. And that's great. It's going to be great. It's going to be a great February, March, and April. But unfortunately, May, June, and July are right around the corner.
Well, and again, but at the end, then we'll have to come back and do another $2,000 round of checks.
Well, no, more than 2,000, right?
Yeah.
It's going to have to be 3,000 this time.
Why is that? Explain.
Because 2,000 doesn't get you any growth. 2,000 is the same as what we just got. You need more to get growth. Economics is all about growth. It's not about absolute numbers.
It's the annual change in the rate of growth, right? So if I do the same amount, I have no growth. I have to keep doing more and more and more and more to create artificial growth. So
the hole gets bigger, bigger, bigger.
Exactly. All right. Hey, Mike, thanks so much for joining us today. Lots of stuff to unpack. And we'll obviously, after we hear what the announcement is today, kind of look at what the details of it are. We'll talk some more about this next Thursday with Mike again, kind of go into the actual details of where this money's going, what it'll actually do, and what it's actually going to wind up costing you as an everyday average American. Thanks for tuning in today. The Real Investment Show. Get by the website, realinvestmentadvice.com. Send us your questions, comments, emails. And if you have a 401k plan and need help managing it, having trouble managing on it, too many choices, happy to help you with it. We can actually manage plans directly now for you. Simply go by the website, send us an email, realinvestmentadvice.com. We'll see you next time.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.